the market is at the same price that it was in July of last year. So 8 months of market gains have gone. Now there's an interesting question that I believe most of you are asking yourself whether it's time to buy stocks or not. Let's look at two extreme scenarios. The first one is that the market has already bottomed today. So if you don't buy today, then you're missing all the future gains. But there's also another extreme scenario where the market has not bottomed. It will go further down. Maybe after 2 years, then it will bottom. So it will go down maybe 50%. And if you buy today, then you're going to lose more money. Of course, nobody knows what's going to happen. Nobody can tell you for sure what's going to happen. People will come up with hypotheses of why the market should go in a particular direction, but nobody knows for sure. Because if these people were right, maybe one or twice they were right. If they were right all the time, then they would be the richest people on earth. But we know the greatest investor ever, Warren Buffett, doesn't time the market. So I won't try to time the market, but I can tell you how I'm going to navigate the current situation. Because a fall like this, it happens only maybe every 1 or 2 years. It's not that often. I will answer this question immediately. Am I buying stocks? Yes, I'm buying stocks. But I want to be careful in buying stocks. And it's not just because the market is going down, it's because I'm always careful buying stocks. So I don't know what's going to happen next. Let's say in my portfolio, there are stocks that are undervalued. And even on my watch list, I see stocks undervalued with a margin of safety. Among all these stocks, I'm not going to buy all of them. I have to choose the best. And by the best, there are many different criteria that I take into consideration. I'm not going to discuss all of this today. There's management, there's the way they do capital allocation, the returns on equity, returns on invested capital, how efficient the margins, everything about these companies. So there are companies that are better than others. That's something we all know. But also pricing is important. So now let's say there is a very good company trading at 70% its intrinsic value. So there's a 30% discount. And then there's another one trading at 60% its intrinsic value, 40% discount. But it is a less good company. Which one among these two are you going to invest in? It all depends on you. I'm not going to give you the answer. But you should be willing to overpay a little for quality. I'm not telling you to buy a stock above its intrinsic value. It's still undervalued, but you're overpaying a little compared to the less good stock. And in situations like this, you need to prioritize the higher quality stocks, because if you have a recession, these companies are going to do well. If they have good capital allocation, maybe they are buying back shares. For example, Booking Holdings, a stock I have been buying a lot lately. But I won't say that Booking Holdings is the most undervalued stock in my portfolio. They are more undervalued stocks. That doesn't also mean that I'm going to rush and buy all the shares possible of Booking Holdings. I've taken my time. If today, let's say the stock is undervalued by 25%, I don't know, maybe next week it's going to be undervalued 20%. Then I'm not going to buy more. But if it's undervalued 30%, I'm going to buy even more. So take your time to buy. If you miss the opportunity to buy, it's okay. It's okay. It's going to come back later. You'll find other stocks. Take your time to buy. Don't rush and just buy immediately. But this raises another question. Where do you get the cash to buy those stocks? And here, that's why it's important for you to have some overvalued companies in your portfolio too. As you know, I've been taking profits on Meta since maybe a year, I'm not sure. I have been taking profits on Meta, but not immediately. I don't sell everything all at once. I take my time to take profits, just like I take my time to buy stocks. And as Meta got more expensive, I took more profits. Today, I believe Meta is still overvalued and I'm still taking profits. This is one source of cash. It's not just Meta, there are other ones too, but I'm just giving you this one as an example. Of course, it would have been better if I sold all my shares on Meta at the top 2 weeks ago, but there was no way for me to predict that. So it's okay. I'm still taking profits. The way you have to think about it, let's say Meta is trading at 40% its intrinsic value. So for each dollar of Meta, you are paying $1.40. But now there's another stock trading at 70% its intrinsic value. So for each dollar of the company, you're paying only 70 cents. If you sell Meta, one share of Meta, and you buy the other company, in other words, you're taking $1 to buy $2. Because you sold 140 cents and you're buying 70 cents. So you gave only $1 to the market and you're getting $2 of value. This is how you need to think about it. and you need to look at a bigger spread as possible, but of course, keep into consideration quality. What happens now if, let's say, you don't have any overvalued stocks in your portfolio? Maybe, let's say, you're so good that you were able to time at the perfect time, you took all your profits on Meta, now you don't have anything to sell to buy other companies. Here, once again, you do comparison. If there is a company undervalued by 20%, so 80 cents on the dollar, and another one 40 cents on the dollar, you buy it, you sell this one, and you buy the other one. It's the same transaction as before, that you're giving $1 to get $2. It's the same transaction. So it's okay to sell a stock that is undervalued, even if there is another one, probably a better one, that is more undervalued. It's all about opportunity cost, where you're getting the most value. You want the intrinsic value of your overall portfolio to increase over time. The stock price, it doesn't matter that much. It's the intrinsic value that matters the most. If the market keeps going down, another important source of capital for me, of cash for me, would be slow growing stocks. These stocks are doing better compared to, let's say, the rest of the market, because maybe they pay dividends, good dividends, maybe they are more defensive. So these stocks are doing better compared to the rest of the market. But if, let's say, there's a high growth stock, Booking Holdings, and at some point Booking Holdings is trading at 50% discount, of course I'm going to sell the good paying dividend stock and buy the other one, because I want to grow in the next cycle. I don't want to be defensive on the next cycle. I want to grow as a maximum speed as possible. Another way you can achieve that is through cyclical stocks. But at this point, commodity stocks, cyclical stocks, but at this point, I don't want to do that. They are not that undervalued. And I prefer a bigger margin of safety with such type of stocks. I don't know about you. Maybe you think that all stocks are cheap right now. I don't know. But for me, they are not. There are 3 stocks that right now I believe are undervalued, and I have started buying those stocks recently. I'm still buying those, but I have added a few to the list. If you're interested to know about these 3 stocks, I would recommend you watch this video next. Have a nice day and goodbye.